It has been an interesting month for the economy. First, Trump was elected president. Then the stock market broke a new record high. Then Bitcoin broke a new record high. And now everybody's wondering, what's coming next? According to some people, our markets are starting to overheat and we're setting ourselves up for an epic market crash, while others are saying that we're getting ready for the biggest economic boom of our lifetime. Now I know, I'm just a random guy on YouTube, but here's the reality that most people are too scared to tell you. The reality is, nobody knows what's going to come next year. Everybody has an opinion, everybody has a guess, but that's all it is. It's just a guess. Markets could boom, markets could crash, or markets could go sideways. But my goal for you isn't to try to guess what's going to happen in 2025 or 2026 or beyond, but rather understand how you can profit no matter what happens in the market by understanding the economic shifts that are happening, because that's what a financially savvy person's going to do. If you're just trying to guess what's going to happen, now you're trying to time the market and you're gambling, and you can make a lot of money, but you can also lose a lot of money. But if you understand how to profit no matter what's happening in the markets, now you have found a way to win. That means, number one, set your investment strategy, because a lot of people say that they're long-term investors just investing their money into the S&P 500. But then when you hear Trump wins, now you want to know how you can profit off of the Trump presidency. But if you're just a long-term investor, investing in ETFs or index funds or mutual funds, now you're not investing for election cycles. You're investing for the long term. So it shouldn't matter what's happening in the White House, because you're just investing for the long term. If you want to be a little bit more sophisticated, a little bit more involved, well, now you're taking on more risk. You also have more potential reward, but it's going to take on more work and more time. And this is where you have to understand what strategy and education you use to find a new investment opportunity. Are you looking for market shifts? For example, when we have a new president, that's going to create a government shift in spending, because the president is going to dictate where some of the government federal funding is going to be spent and how it's going to be spent, and that can impact certain industries, certain companies, and certain stocks. This is what I call a government shift. But again, this takes more work, more research, more risk, and you have to decide what's right for you. Now, for those of you that are interested in this type of government shift, I'm hosting a free, live, and virtual workshop where I'm going to be going over Trump's policies and how they can create a government shift and where those opportunities will be, which industries, which potential companies could benefit based off of the policies that he's talked about so far. It's completely free. It's on November 19th at 10:30 a.m. Eastern Standard Time. No, there will not be a recording. I'm hosting a one-time live. So if you'd like to join me, I have the link for you to join for free down in the description below. Once you have an idea of your strategy, if you're more of a passive investor versus active investor, the second thing you want to do is understand what's happening in the economy so you can stay on top of shifts happening in our economy. So let's talk about where our economy is today. On October 30th, 2024, we got a report saying that our GDP, our economy, grew by an annualized rate of 2.8%. That means, according to the data, our economy is growing faster than what a lot of people expected. But for full transparency, let me read you what the government had to say about this data. The GDP estimate released today on October 30th is based on source data that is incomplete or subject to further revision by the source agency. The second estimate for the third quarter, based on more complete data, will be released on November 27th, 2024. So while the data is incomplete, according to the data, it says that our economy is growing faster than expected, and our GDP, our economy, is expected to be around $29 trillion by the end of 2024. Now, what you have to remember is that the largest spender in our economy, because GDP is a measure of spending, is not Jeff Bezos, it's not Amazon, it's not Walmart. The largest spender in our economy is, of course, the government. And what we have seen throughout 2024 is that that largest spender, government, has been increasing its spending, which has contributed to the growth in the GDP. Let me read you what the Treasury Department has had to say. The Biden administration rang up a budget deficit topping $1.8 trillion in fiscal 2024, up more than 8% from the previous year, and that's the third highest budget deficit on record, the Treasury Department said. Why does that matter? Because there are two types of spenders in our economy. We have private spenders, these are people and businesses, and then we have public spenders, which is the government. We know that private spenders don't have an unlimited pool of funds to spend. You got the money that you have in your bank account, plus whatever banks are willing to lend you. Same with businesses. The government doesn't work that way. the government has been increasing their spending even though it is a budget deficit, meaning they're spending money they don't have, which still contributes to the GDP, although there is a consequence to that, which is inflation, but I'm going to save that topic for a later video. The reason why the first thing I'm talking about is the economy is because if we do see an economic slowdown, or even worse, an economic contraction, that's a problem because that means, number one, people aren't spending as much, businesses aren't spending as much, our economy is shrinking, so businesses are making less money, and then eventually that also means that asset prices like stock prices, maybe even housing prices, maybe even crypto prices could get hurt because that means that the economy is not doing so well. So that's why the economy matters and why you want to pay attention to what's happening in the economy, because if the economy is growing, then that can help contribute to growing asset prices. But if the economy is shrinking, then generally that means asset prices get hurt too. I say generally because there's always exceptions. This is where things get very interesting, because of course we have a new president entering the White House in January, and Trump hopes to boost the economy and boost the stock market through his new economic proposals, but all these things are still speculation today because nothing has been approved and we don't know what the impact of the things that are approved will be. Then we have inflation. The most recent inflation report that we got said that CPI inflation came in at 2.6%, which is a little bit higher than where we were the previous month, but this is where Wall Street and the Federal Reserve Bank are saying you have nothing to worry, and Wall Street is saying because this is such a strong and good inflation number, 80% of Wall Street investors and traders are predicting a Federal Reserve Bank rate cut come December 2024. What does that mean? That means the Federal Reserve Bank says that they want 2% inflation. That's what they have been saying for many years. That's what their goal is. Are we at 2% inflation? No. Month over month, we actually saw this inflation rate go up, not down. But according to the Federal Reserve Bank, which is the central bank of the United States, this inflation number is not something you need to be concerned about, and they believe that we are still on target to see 2% inflation at some point in the future. Now, there's a lot of factors that can influence inflation. For example, lower interest rates can contribute to higher inflation because lower interest rates mean that more dollars are going to be created and lent into our economy. Or for a simpler way to think about it, if interest rates really go down and mortgage rates were to fall to 4% tomorrow, a lot of people would probably start buying houses again, and you might start to see more bidding wars again, and that could push up house prices again, which could make the inflation problem worse. So lower interest rates can contribute to inflation, and the Federal Reserve Bank looks like they'll be cutting interest rates in December again, but also government spending can also contribute to inflation. So we talked about how the economy is made up of private spenders and public spenders. Well, the government spends somewhere between 20 to 30% of our GDP, depending on which report that you read. And so what we know in 2024 is that the government has been ramping up this public spending through deficit spending. Deficit spending means the government is spending money that they don't have. So any money that the government spends is a tax. Either they're going to spend money that they generate from you through your taxes, whether it's your property taxes, your sales taxes, your income taxes, whatever it might be, or if they spend money that they don't have, which is called your national deficit, then they have to raise this money through debt. And many times they borrow this money from the Federal Reserve Bank, which means the Federal Reserve Bank has to create this money and lend it to the United States government. So this money gets created out of thin air, it gets lent to the government, and then that goes into our economy. Now remember, more spending is good for the economy, but that can hurt the inflation problem. So generally when you see a recession, you see a bad economy like we saw in 2020, we saw in 2008, we saw in 2000 and 2001. What you see happen is the Federal Reserve Bank works to create inflation. They work to stimulate the economy. How do they do that? By cutting interest rates and printing money. There's two ways to create this inflation to stimulate the economy. The difficult part is after the 2020 pandemic, that's what we did, but that created an inflation problem. Because that's where we led to the 2021 inflation, the 2022 inflation, the 2023 inflation, and even the 2024 high inflation. And this is where now the concern that many people have about the Federal Reserve Bank potentially cutting interest rates and the government continuing this deficit spending is that it could make the inflation problem worse. And then the third piece of major economic data is our unemployment rate, which at the time of recording this video is 4.1%, which is higher than where we were back in 2023, but it is historically very low unemployment. Now, every time I talk about this unemployment rate, Everybody says, well, Jaspreet, that doesn't give you the full picture. And you're 100% right. This 4.1% unemployment number doesn't give you the full picture because it doesn't include people that have been unemployed so long that they no longer qualify for an unemployment check. It does not include the people that are working 2 part-time jobs. It doesn't include the people that are partially employed or underemployed. So yeah, this 4.1% unemployment number doesn't give you the full picture. And I get it that there's a lot of difficulties in the job market today. But this is what the reported number says. And so this reported number of unemployment is historically very low. Why does this matter? Because the Federal Reserve Bank follows what's called a dual mandate. They are supposed to make their decisions to cut interest rates or print money based off of 2 things. Number 1, maximum employment, and number 2, price stability. Meaning number 1 is they want to look at unemployment, and number 2, they want to look at inflation. These are the 2 things that the Federal Reserve Bank is supposed to look at when it decides to raise interest rates or cut interest rates. Well, when do you cut interest rates? To stimulate an economy and to raise inflation. If unemployment is still historically very low and inflation hasn't hit the 2% target yet, why do we need to cut interest rates? Well, according to the Federal Reserve Bank, we need to cut interest rates as a way to continue stimulating the economy, proactively stimulating the job market, because inflation is not a problem. But this is where I want you to question that line of thinking for a second, because 4.1% unemployment. This is what the data says. If we take a look at the last 50 years, we're at some of the record low unemployment numbers. I mean, this is considered very good by any historical measure. So why is the Federal Reserve Bank really wanting to cut interest rates? Why are they really wanting to stimulate during this time? And there's a couple of reasons for this. One could be that we have $36 trillion worth of national debt today. That is a whole bunch of public spending, deficit spending that is accumulated. That is our national debt. And now when you have this amount of national debt for the government, you have to pay this money back plus interest. Now when you have to pay this money back plus interest, there's a couple things that go into play here. Number 1, the interest rate is going to impact your interest payment for the government. And as of today, the time of me recording this video, the government is paying more money in interest than they're paying in funding the entire military. So a lot of our tax dollars are going to just pay back interest. And then the second problem is when you have to pay this money back, it can be expensive. But if you have inflation, the value of each individual dollar actually goes down. Because if you have inflation, now you're paying back the national debt with cheaper dollars. You're inflating away the value of the national debt. And that's where the Federal Reserve Bank may get that benefit to potentially cut interest rates, because it makes the national debt cheaper and it also makes the value of the $36 trillion cheaper. For example, $100 today in 2024 is not as valuable as $100 back in 1954. In 1954, $100 could buy you a whole lot more. Why? Because of inflation. Inflation has made the $100 much less valuable today. And that's where if we reduce the value of the $36 trillion worth of national debt, it makes it cheaper to pay back. So those are the things that are happening. Now let's tie this all together for you as an investor. How do you profit no matter what? The first thing you have to understand is that market crashes happen and recessions happen, period. The reason why I say that is because recessions generally happen when people don't expect them to happen. When everybody expects a recession to happen, it generally won't happen, because then everybody is taking their cash, putting it on the sidelines and saving some money for the market crash to happen. That way they can jump in and buy at a discount. But when everybody thinks the markets are only going to go up, that's when people start to exhaust this money on the sidelines, and that's when it's more likely to see that crash or recession. Now again, nobody can predict when things are going to happen, but you want to be prepared for whenever a market crash happens, because a lot of people get into this exuberance mindset where they think nothing can go wrong because markets have been going straight up, and so now they want to dump their money in there, maybe even invest on margin. And if then things start to go down, people start to panic. And this is where the first thing is, you want to be prepared for anything, no matter what. Doesn't matter when or what we're talking about, you always want to be prepared for that downturn. That's the first thing that you can do to profit no matter what happens, is be prepared for a downturn, because those recessions, those market crashes create more millionaires than any other time, because you can come in, buy good investments at a great price. Number 2, how do you profit if things go up? Well, that means you have a strategy to buy good investments. And either you're investing passively, which is you're investing into something like the S&P 500 every week or every 2 weeks or every month. That way now, whether the markets are going up or down, you just keep buying more. Or you have more of an active strategy where you're looking for individual companies that you believe are primed to grow in the next few years. That is the way that you make money when markets go up, is you own the investments that are going up. And number three, if markets are going sideways, you just keep using that as a time to accumulate. And if you're generating cash flow from your dividends, well, you're getting paid even if the asset price is not going up. So if you want to win as an investor, you have to, number one, understand your strategy. Number two, you have to understand what's happening in the markets. You have to understand the economy. Of course, Market Briefs is a free newsletter, by the way. My team publishes it every day. We break down what's happening in the markets. It's completely free. If you haven't joined Market Briefs, I got that link free down in the description. And then number three is you have to know how you can win and profit no matter what's happening in the markets. Again, for those of you that are more fundamental investors and you want to understand how a Trump presidency can create new opportunities in the stock market, I'm hosting a free workshop for you. That link is also free down in the description. But that's why I want you to be a financially savvy investor, not an emotional investor, because that's where the real wealth is built. That when everybody's getting excited, everybody's talking about how nothing can go down, you understand how do you find the profits, and you just take a step back. Versus when everybody is crying, everybody's panicking, everybody's freaking out, that's when you come in and you're ready to buy. Buy low, sell high. But what do you do in an economy like today where markets are setting record highs, even though many people are still concerned about the economy, and now investors are hopeful that Trump is going to save the economy and boost the stock market? So is this the time to double down and buy even more? Or is this the time to sell high and cash out of your profits?